Hello, everyone. Today on the final bar, we will wrap this week, and it has been a painful end to the week. The S&P, the Nasdaq, the major averages Thursday, pretty much spending the entire day going down and to the right, picking up right where it left off this morning. Continued downside, a bit of a bounce after 3 p.m., but really finishing at the lows. The S&P down almost 3%. What does that mean for the big picture for stocks? Ladies and gentlemen, this is the final bar. Hello, everyone. Happy Friday. It's Friday, April 22nd. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the technical analysis toolkit, using charts to better understand market history, to better interpret market dynamics, and better embrace investor psychology. If you're looking for a read on what the overlying psychology is right now with investors, hard to think of anything but risk off at this moment. With yesterday and to today, you're seeing very much a move away from risk on back into risk off. You're seeing things like consumer staples, utilities, real estate at the top of the list. You're seeing the major indexes pound through potential support levels. And what's most concerning for me, I was talking with Grayson Rose a little earlier today, you're seeing stocks that are breaking down that really shouldn't, right? In a normal textbook technical environment, stocks making nice rotations usually continue to build momentum and go to the upside. You're seeing a lot of healthcare names, big gap downs. You're finding charts like Alphabet failing to hold support. This is a bearish environment that I think we are definitely in here. We're going to look at a lot of charts to back up what I just said. We had great guests this week. I had a lot of fun talking with Tony Dwyer, Javed Mirza, some really thoughtful analysts, Jesse Felder as well. Next week, a little different. On Monday, Tuesday, Wednesday, the StockCharts TV team is actually taking a bit of a road trip. We're going to a broadcasting conference, hoping to upgrade the audio-visual experience for all of our viewers and our StockCharts users. So we have some really cool content lined up for you. On Monday on the show, Trend Following 101. On Tuesday, we'll break down some of my favorite breadth measures. And on Wednesday, talk about how to use price ratios to better understand stock relationships. Then next Thursday, Jeff Hughes from JWH Investments. The week after, on Tuesday, May 3rd, I'm excited to have Jeff Weiss, who's one of my early mentors in the industry, coming back on the show. Today's show is kind of a fun one on Fridays because we wrap the week. This is where we focus on how the markets have evolved from last Friday to this Friday. We have a lot of really cool charts to share with you, but first, I want to get to a poll. We often have a poll running on our StockCharts live stream page, also our social media accounts. So make sure you follow us on Twitter and subscribe to our YouTube channel. You make sure you get some of these polls and be able to share your insights back with us. We asked you, will sell in May and go away be good advice for investors in 2022? 55% of you said yes, that is indeed going to be a good game plan for the year. 45% of you said no. That's not a huge overwhelming majority there, but that certainly is a majority voting for yes rather than no. I mean, the chart that I think tells that story probably better than anything. If you go to our seasonality charts, we bring up the spiders, and you can look at different time frames. We'll back up to the last 20 years or so. Here's the idea, right? There are certain times of the year when the market tends to do pretty well. November and December tend to be some of the strongest months for stocks. That's sort of the the rally into the end of the year. Seasonal trends tend to be pretty strong. So when you get into the holiday season, a lot of consumer spending and people in general, pretty good mood going into year end. January tends to actually be a pretty difficult month because more often than not, the big rally, the big exciting moves that you had going into year end, this is when things kind of come back to earth a little bit. Then you get into February, March, April. And April, if you look, 80% of the time, going back for the last 20 years, 80% of Aprils have been higher than they started. And on average, it's the strongest month. If you look at the average return for the spiders, about 2.7%. Again, an average of all the Aprils going back for the last 20 years or so. So out of all the months, April tends to be the strongest. That's why sell in May and go away tends to be a pretty good thing because these lighter months here, the summer doldrums, are when the market tends to not perform as well. You can see that batting average in the middle of the year, it tends to be weaker than some of the other months. You can see the average returns are some of the lowest ones that we will get. The two weakest parts are sort of January, February, then the middle of the year. Things like June, September tend to be pretty weak, and a lot of the major market bottoms have happened in September and October. So it's interesting, given the weakness that we're seeing right now. A lot of you are saying sell in May and go away seems like a pretty good idea. Sell in April and go away is not an option we gave you, but if it was, I wouldn't be surprised if some of you potentially opted for that one. Let's look just very quickly at what the markets did today, and we'll continue with our Wrap the Week segment, going through some of the key charts to tell the story of this week. Today was a pretty tough day. Anything equity related, the best performing sector was consumer staples, still down 150 basis points or 1.5%. Materials was the worst performer of all, down almost 4% today. The S&P, the Nasdaq, the Dow, all down over 2.5%, and some of them much more than that. The VIX has spiked a little bit higher, getting up to almost 28. And it's interesting, we were just talking about the VIX yesterday, talking about volatility and how the VIX bottoming out around 20 has ended up being a pretty interesting signal. So far, that thesis is playing out just magnificently with volatility spiking and the S&P, the Nasdaq pulling back after attempting to regain previous highs. Just very quickly on some other asset classes to talk about how today played out. Pretty tough day for stocks, but sort of a flatter day for bonds. Interest rates really didn't change a ton from yesterday. 30-year yields were up a bit. 10-year yields were down a little bit. The TLT, which is the main indicator we use for bond prices, down about 0.2%, and the dollar index up a bit from yesterday's close. Commodities as a whole coming off with gold, silver, the DBC, a broad commodity index, finishing more toward the lows of the days. Cryptocurrencies essentially mixed, but the largest ones, things like Bitcoin, Ether, all coming off. Bitcoin now below 40,000, Ether now below 3,000. These are some key big round numbers, potential areas of support and resistance that we've talked about. It could be some interesting charts to follow over the weekend to see if they recover any from this distribution phase that we've seen played out today. Let's go to our Wrap the Week chart. So this is a chart we look at every Friday, and what we do is we look at the last Friday's close. In this case, we're looking at the Thursday right before Good Friday of last week. So taking the end of last week to where we finished this week, and what were the returns of the major asset classes. If you follow my mouse and my voice, I'll talk through what each one of these lines represents. In black, we have the S&P 500, which finished the week down 2.7%. So the beginning of the week wasn't too bad, but obviously showing some distribution here as the S&P attempted to regain those previous highs, getting up to that 200-day moving average, and then Thursday and Friday really giving all of that back and more, finishing pretty weak. It was almost flat for the week yesterday. All of today's sell-off really pushed it to the negative column. A number of things underperformed the S&P this week. In purple, we have the Russell 2000 ETF down 3.1%. In pink, we have the Nasdaq 100 ETF, the Qs down 3.9%. Down here at the bottom, you have two very near each other. This is crude oil, the USO, and emerging markets, EEM, both down over 4% for the week. Everything else outperformed the S&P. Here is gold, down just about 2% using the GLD. In blue, we actually have Bitcoin, which finished the week as of right now down about 1.2% from last Thursday's close. In red, we have the TLT bond prices down about 0.6%. The only thing up for this week out of these major asset class ETFs that we're tracking, the dollar, the US dollar ETF, the UUP, which finished up 0.8%. I've been thinking a lot since Jesse Felder was on the show on Wednesday. Tuesday, I think that was. We have a lot of great guests on the show. I would very much encourage you to go through the 3 conversations I had this week because I thought they were fantastic. We had Jesse Felder talking about, big picture interest rate environment, some of the indicators that have preceded recessionary periods and what a stronger dollar, stronger commodities has tended to mean relative to equities. We had Javed Mirza talking about some long-term charts, more of a bearish take, the prospects for a secular bear market in stocks. Yesterday, Tony Dwyer talking about the Fed, and I think did a great job of sort of making sense of some of the recent comments we've had from the Fed and the potential impact on the equity markets as a result. So 3 really good conversations. And again, the stronger dollar reminds me of Jesse Felder's comments about dollar strength, along with some of the other strength in charts that we've seen and what that tends to mean for weaker equities. Let's finish off our Wrap the Week segment going through the Mindful Investor Live chart list. This is a list of charts that I keep updated on StockCharts.com. If you ever want to check in on these, you can. You go to the Articles tab on StockCharts, go to my blog, which is called The Mindful Investor, and you'll see a gray button at the top that says Live Chart List. You'll see the most recent versions of all the charts we're going to share. I also wanted to call out just about an hour ago, we posted, and to be totally clear, Julius de Kempener very kindly put us both on the author list. This is very much his work that I was very lightly a part of. So let's give it credit to Julius. He did a really good job of laying out some long-term perspective and incorporating some of the rotation that he and I have been talking about over the last couple of weeks. So make sure you check out that article. It's actually really, really well done. And Julius did a fantastic job with this one. Let's go through the Mindful Investor Live chart list. We start with my market trend model. Last Friday, we actually didn't have a show. I was on vacay in Oregon, but if we did, I would have told you that the market trend model had turned back negative. It's only about a 2-week stint for the medium-term model being bullish, about a 3-4 week stint for the short-term model being bullish. From there, they've both turned bearish as of last Friday, and clearly with the weakness you see going into the close, remaining bearish. So my long-term model remaining bullish, although becoming less and less so. Getting below the zero line would be a significant development that we've only seen twice in the last 5 years. Once first quarter in 2020, the second was the fourth quarter of 2018. Two of the major corrections, or the most significant corrections that we've seen in the last 5 years. So that would be a very negative sign if we get down into that pattern. The medium term and short term, and the medium term is the main one that I use for risk on versus risk off, has gone back negative last week. So that tells me is to just in general focus more on preserving capital as opposed to growing capital, to focus on keeping stop losses updated to make sure that you cut things out of the portfolio when they no longer deserve to be there. And again, the good thing about technical analysis is the charts will tell you when something should not be worth your capital anymore, because the charts go down, right? The price breaks support, the price fails to hold key support levels, and it tells you to go find greener pastures. The daily chart of the S&P is next. A number of things concern me about the last 48 hours. We're going to get a little later to some of the individual stocks that I think are concerning, but I'm struck by some of the conversations I had this week. We had our StockCharts draft, which we recorded some of the content for earlier this week. Our TV team, particularly Gretchen, one of our producers, doing a really good job of producing that in a way that's going to come out looking really, really good for all of you. But the conversation was fantastic, and it was a fairly defensive discussion about where to be in stocks. There were very few what I would call juicy offensive plays that were incorporated into the stock picks that I heard as we were debating that. We had our latest episode of The Pitch yesterday, and I had a great discussion with Jessica Inskip, with Ms. Schneider, and with Jay Woods about some of their stock ideas. There were utilities, REITs, consumer staples. These are the types of stocks that were coming up in our discussion. It was more ways to ride out uncertainty and less reloading. So the concern that I have as I'm talking to knowledgeable experts about where they're positioned defensively right now. We're talking about the potential for further downside and some of the guideposts that might confirm that for us. And I think we're seeing in earnings season, companies are actually beating earnings. There are some companies doing just fine, but the stock prices are not going up. Nucor, NUE is a name that actually broke higher on their earnings release. Tesla gapped higher after a decent earnings quarter. Both of those stocks actually finished at the lows of the day yesterday and continued lower today. So overall, you're seeing good companies potentially. I don't know if we can label all those as good companies, but companies reporting good earnings and having a good quarter. And the initial rally is met with fierce selling resistance, or at least the lack of buying power. And that is the sign of a bear market. That's the sign of investors not willing to take risks right now. That is not what a bull market is made of. So when I'm looking at the daily chart of the S&P, that was a long-winded intro to saying when a chart attempts to regain its 200-day moving average, fails, and then follows through to the downside, that is not an encouraging sign. Yesterday's close put us right down to the 38.2% retracement level, which was around 43.80. And we've talked about how important that level is. That's a blue shaded area on the daily S&P chart. We've tested that a number of times. Yesterday's low was right about there. Today, we pushed obviously right down below it. We even got below 4,300, which ended up being support of third, fourth quarter of last year. The September and October lows were right around the same level. I would argue that the major bottoming pattern that we've been seeing so far, January, February, March, has all been within this range. We're now in the the rounding error of the long-term lows here for the last 6 months. So I think at this point the low is in play. I think 4,200 is a really important level to look at, because that's the first Fibonacci support level using September 2020 to January 2022. We're not far off of there. Another down day next week could easily put us right there, or even worse. The RSI is getting below 40 as well, which is a concern. Breadth is interesting. Now, some of these breadth indicators have not been updated yet, particularly this one. They will all most likely turn much lower after, given today's sell-off. Pretty much everything was down. So these advanced decline lines are going to be skewed very much to the downside, I would assume. But it's worth noting, when I'm looking at the advancers decliners, a number of these, all four of them, attempted to regain their February peaks. That's the blue horizontal lines on each of these charts. All four of them failed to be above them for even a day or two at most. And after that, we've come back down. Now, some of these have made new lows, like the small cap AD line. Look at how the large cap AD line, the S&P, is actually right about where it was at the February and March highs. Some of these are actually a little bit further down, and some of them, in particular the small cap advanced decline, has already made a new low. So I'm concerned. I'm interested by the fact that the large cap breadth has actually hung in there. Finally, percent of stocks above their 50-day as of Thursday's close was about 58%. I would assume, given the deterioration we saw today, that number is going to go down for Friday's close here when we start brushing up all that data after we process the closing. But these indicators remaining above 50% tells you shouldn't be that negative, because things are probably okay, right? Stocks are holding in there. But the more that these get below the 50% level, which it could do once we process Friday's close, I think that's a concern, and tells you that a retest of the lows, 4,100, 4,200, much more likely. We need to take a quick break. We'll be back answering your questions from the Final Bar mailbag. We'll see you in a minute. Hi, welcome back to the show. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we break down the activity in the markets using the power of the StockCharts platform to better quantify investor behavior, better look at trends, momentum, breadth, sentiment. There are some times when it feels like these things are not necessary. I will tell you, this is not one of those times. I would be digging into the platform as much as you can and try to help yourself make better decisions here. Take advantage of our great contributors sharing their expertise, because they've seen these sort of movements before. A couple quick announcements before we get to the Final Bar mailbag. First off, our mailbag questions come from all of you. We appreciate so much you emailing us, tweeting us your questions, and sharing what you're running into as you try to use technical analysis to better understand the markets. Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air next week in our next mailbag segment. Also, go to StockChartsTV.com. That is our on-demand platform. You can get so much fantastic content. Our upcoming Stock Charts draft, which will be airing next week. Our latest episode of The Pitch. Larry Williams did a fantastic market outlook, fairly bearish in the last week, which is on there as well. All that is for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. Let's continue on with our Stock Charts Final Bar mailbag. Our email is thefinalbar@stockcharts.com. Let's get to question number one. David, could you talk about your best advice concerning setting stops for stocks and ETFs? What prevents my slate from being wiped clean if the market has drifted lower for a couple of days, then has a bad opening on Monday morning? That seems like a big disappointment to watch things rebound by Monday afternoon after my stops got triggered in the morning. Really good question. And I'll bring up one of the stocks that I was looking at here. UHC, I think it was. No, let's see. UNH isn't a bad one. United Healthcare is a name, down about 3%. A number of names within the healthcare sector have come off pretty good. Like ISRG is another one. These are names that had started to show some improvement, but healthcare getting crushed today, as most things are, just down fairly significantly. And your question implies what I think is the challenge. What we all want when you're thinking about stop losses is the holy grail of stop losses, which it only triggers a stop if it's the beginning of something really bad, but it doesn't trigger a stop if this is just short-term blip, and then it goes right back up. And that's called a whipsaw. When you feel the market is doing a certain thing, or you get a signal that the market is doing a certain thing, but by the time you actually take action on it, that move has reversed, and all of a sudden you just sold or bought at the perfectly wrong time. I wish I could tell you there's a perfect way to do that. There isn't. I think that's one of the challenges of stock investing or of ETF investing, or really with any asset classes, these whipsaws. And the challenge is making your stops sensitive enough that you don't give up all of your gains before the stop triggers, but making them wide enough that you're actually respecting the fact that the market has natural volatility, and sometimes things are just going to swing just because they're swinging. So that was a long-winded way of saying there's no perfect answer for it. What I would encourage you, some of the tools that I found most helpful are using things like volatility, have a volatility component. Moving averages are a very simple way to think of stops, holding a stock as long as it remains above the 50-day or the 20-day or whatever you think lines up with your time frame can be a good starting point. But I will tell you, it's very much a shotgun approach as opposed to it's not using a scalpel for that. It's using more of a broad, sometimes not super accurate way of doing it. It's trying to use the same tool on everything. Something that adjusts for volatility is a little more dynamic. So I think of things like in Alexander Elder's work, things like the chandelier exit system comes to mind, which is something that is basically designed to keep you in a trade as long as it's working, and to get you out of it when it stops working. So this green line that I put on here is called the chandelier exits. What this is designed to do is track the price on the way up and really, give enough room, because it's based on average true range. So it's based on how much the stock actually tends to trade. So I would look at things like ATR, things like the chandelier exit system, other, parabolic studies, which is a Wells Wilder product, has a bit of a volatility component to be more or less sensitive depending on how volatility the asset class or the particular ticker is. I would encourage you to use things like that are a little more dynamic. That should try to help address the challenges you're facing. The other thing I would say is, remember, I often pay a lot of information to the closing bell, right? Where a stock closes has a lot of meaning, because a lot of times you'll have something move below a trigger, but then close back above it. That's why I always talk about confirmation. Once something closes through a key level, that might not be enough to really take action. You want to wait for the next bar to see if it confirms, right? Because a lot of times you will open and then move completely in the opposite direction. That happens quite a bit. I hope that helps point you in the right direction. Next question. Imagine the S&P 500 goes down to 3,800. Then what should be the expectation? So I have to be very clear. I don't know. And anyone that tells you they do know is lying to you or lying to themselves. I can tell you what I think could happen, because at the end of the day, I think analyzing any chart is all about thinking about probabilities. As much as we try to tell you it's a certainty, the markets are going down, the markets are going up. This stock is bullish, this stock is bearish. We do that for brevity, and we do that for clarity. In reality, when I've been in a money management environment, you can't think that way, right? You have to think in terms of probabilities. You have to think about managing risk. You have to understand that you're going to be wrong a lot. And that's how institutional investors deal with this sort of uncertain environment. You recognize the fact that some things aren't just going to work. And it's all about making sure that you let your winners run and make sure that you cut your losses. So having said that, imagine the S&P goes down to 3,800. I think that is a fantastic exercise for us all to do. What would it mean to your current portfolio if the S&P went down to 3,800, which would be the 61.8% retracement of September 2020 to January 2022, by the way? What would your current holdings do? What would your growth stocks or a particular ETF, a particular sector most likely do given that environment? What sectors would potentially lead? What events would happen to cause that? All thinking through those scenarios helps make it a little more real if and when something like that would actually happen. It will make you better prepared for it. I actually put a video on my YouTube channel just yesterday with this idea in mind, talking about a very bullish scenario, the S&P goes up to 4,800, a very bearish scenario, the S&P goes down to 3,800, and a couple in the middle, and talking about some of those potential details. Go to my YouTube channel called Market Misbehavior. If you want to check that out, you can vote on which scenario you think is most likely. Your scenario that you're talking about, I think, is absolutely possible. If you think about what's caused the market to come down, strong earnings have not been enough to push the broader equity markets higher. The FANG stocks, things like Alphabet and Google, which should be holding support in a bullish environment, are failing to hold support. Google getting below 2,500, I think, is a very damning piece of evidence for the bull case for stocks. Also, things that have had pretty good runs, things like healthcare and energy, which have been showing some strength, are showing some short-term weakness. Gold stocks, which have been emerging, are rolling over. So I think the case for the S&P down to 3,800 is further deterioration in some of these charts that are just starting to break. And it's the growthy stuff would most likely be leading further on the downside. The speculative high beta stuff, small caps would be underperforming and kind of going down there. And it would be also further embracing of, I think, the reality of what the Fed is going to do, what a rising rate environment means for the markets as a whole and for a lot of these individual stocks that have had pretty good runs up until now. Next question. One question is how low an ETF or stock will go once in a downturn and how high a sector or stock will go in an uptrend. Are there any simple rules? Enjoy your vacation and have a great week. That was something that came just last week while I was off. And thank you for the well wishes. I wish I could tell you, and I will tell you, we have the chart of Alphabet on here now. Where does Alphabet go now? I would tell you one of the reasons why this show is called The Final Bar is because when I've taught technical analysis to new analysts, to new money managers, what I've always say is start with the current bar, the final bar, and then look to the left. Where are we at relative to where we've been? When you do that, you will see how clearly today's move really takes us below a key support level. 2,500 was a level that had meaning. This is where buyers have come in over the last 4 months and have provided that buying power to push Alphabet higher. That has failed. Either there's no one left to buy the stock and push the price higher, or there's enough selling pressure to overwhelm that potential demand for stocks. So now we have to look to the left and see where the stock has found support before. This is when Fibonacci retracements come into play. This is why my chart of the S&P 500 has these big horizontal lines. These come from going back and looking at where the market has bottomed out before and using those as a framework and saying, all right, if that was a major low and this was a major high, what levels of support might I expect? So there are a number of tools in the technical toolkit. Fibonacci retracements and projections are probably the one that I demonstrate on the show more often, but there are a number of other things like Elliott Wave, like Gann analysis, which are really forward-looking projections about where, in terms of price and or time, a market should turn. I'd encourage you to dig deeper into some of those particular areas of focus. We need to wrap this show, folks, and go to the 3 in 3. Let's talk about 3 charts that tell the story of this market in just under 3 minutes. Here we go. Chart number 1, the S&P 500 daily chart. We talked about some of these key Fibonacci levels in my mailbag segment, had some great questions about how to project where something might go when it's broken out or when it's broken down. And there's no perfect way to do that, of course, because we don't have a crystal ball. And if you think of technical analysis as a crystal ball, I think you're framing it completely incorrectly. That is not how I think of the technical toolkit. The technical toolkit tells you about market history. It tells you about investor psychology. It tells you when investors are excited or desperate or nervous or euphoric. And it also helps you identify potential levels at which a market may turn. I think looking to the left to see where markets have found support or resistance previously is really important. This is why the 4,550, 4,600 level was important. This is how we sort of focused on that and identified that false breakout last month. And I think correctly pointed to the chance for deterioration. I would encourage you to, now that we're selling off, to focus on some of those previous lows, focus on some of the Fibonacci levels and use those to help you better understand market dynamics. Chart number 2 is looking at breadth. We really haven't had breadth deteriorate too much. It's really been more neutral for most cap tiers. Small cap has been the weakest using the cumulative advanced decline lines. But given today's weakness, once these charts update to reflect the closing data on Friday, I think you'll see them coming down quite a bit. I think these lows from February and March might be in play once again, and I would be focusing on that chart to see if you get further deterioration. Finally, there are always areas of the market that are working. This is the chart of CLX. Clorox making a new swing high today, up 1.7%, while the markets are down. There are ideas out there. Make sure you use our scanning engine to find what's working. Folks, that's our show and a wrap for this week on The Final Bar. Thank you so much for joining us. Every weekday after the close, go to StockChartsTV.com for all of our previous episodes. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great weekend.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.